Hello, my name is Tina Tong. I run wholesale distribution in Hong Kong for Aberdeen. I'm here with Josh Stutz, who manages our Aberdeen CCAF1 Global Dynamic Dividend Fund. Today, we will explore why investors might use equity markets to provide income for portfolios. Josh, US growth remains resilient, and most analysts expect interest rates to be higher for longer. What do investors need to think about as they look ahead?
Yes, US growth has been resilient, but economists are talking more and more about a soft landing for the US. Despite high energy prices, elevated interest rates, and geopolitical instability, the macro data continues to be very strong. Now, inflation is starting to recede, suggesting rates are at or near their peak. But none of this is happening quickly. And with rates forecast to be higher for longer, we see a possible US recession on the horizon. But we think it'll be potentially a shallow one. The S&P 500 has continued to rise, with growth outperforming value. But this is driven by only a handful of stocks. We expect higher for longer rates to lead to a slowdown in global growth, with value and dividend paying stocks starting to outperform.
So why will investors consider equities for income rather than bonds?
Traditionally, investors have turned to bonds for income. But when you buy a bond, you receive a static coupon that doesn't grow with inflation. Historically, dividend income has been resilient to inflation. Remember, quality companies that continue to pay dividends whether markets rise or fall. If they fall, you can receive that income payment. And if they rise, you can benefit from capital growth potential while still receiving that income. Dividends have grown about 5.6% annually over the past 20 years, and we're forecasting 7% annual dividend growth for the MSCI All Country World Index next year. Here's why we think income makes sense for 2024. First of all, firms that grow their dividends outperform those companies that do not pay dividends. Secondly, income stocks look cheap both on a relative and historical basis. And finally, companies tend to raise their dividends, which may offset the impact of inflation.
If investing in equities for income can help diversify portfolios, what is it Aberdeen can offer that's different?
We think what we offer is really quite unique, with a two-tiered approach to seek both premium yield and capital growth opportunities. We buy companies that we think can grow their dividends, and unlike many peers, we do not use derivatives to help generate that income. We analyze companies' fundamentals to find the best dividend payers and actively manage a portfolio of 80 to 100 stocks. This makes up about 95% of our portfolio. Additionally, we rotate into dividend and special dividend events to enhance that yield. We buy into these stocks to capture their dividends prior to the ex-date and sell them afterwards. These tactical trades account for up to 5% of our portfolio. Unlike our peers who focus on high dividend sectors, we diversify across sectors and countries and are style agnostic when it comes to value or growth. That gives us more scope to invest in businesses offering attractive total returns over the long term. We look to understand that companies' competitive positioning and ability to sustain and grow those dividends. We have over 120 equity investment professionals in 12 markets globally and have managed our dynamic dividend strategy in the United States for over 10 years. We test our ideas through team review and embed environmental, social, and governance analysis throughout.
Thank you, Josh. In summary, we research fundamentals to target long-term dividends and trade in and out of special dividends. We also invest in firms to target capital gains. The current yield on our CCAF1 Global Dynamic Dividend Fund is 6.7%. With us, investors do not have to choose between income and growth. We aim to give them both.